Index investing is sold to us as the simple solution. Just buy the market, hold on, and you'll win. But what if that simplicity is actually a trap? What if the real risk isn't the market at all, but what's going on inside your own head? So, to really get this, I want to tell you a story. It's about my neighbor, Kevin. Now, Kevin is one of those guys who did everything right. He read the books, he understood that trying to pick stocks was a loser's game, and he puts his entire nest egg, 180 grand, into a simple stock market index fund. He felt pretty proud, and honestly, he should have. He'd sidestepped all the usual mistakes, high fees, trying to time the market, and then March 2020 rolled around. And just like that, in 3 short weeks, Kevin watches his life savings absolutely plummet from 180 grand all the way down to 118. He kept telling himself, stay the course, this is a buying opportunity, I've read about this. But as he was about to find out, there's a huge difference between reading about a storm and actually living through it. And this right here, is the absolute core of the problem. It's the massive gap between what our brain knows and what our gut feels. Yeah, his brain knew the long-term investing playbook, but his gut was screaming, watching his net worth just evaporate while every news channel was talking about a global apocalypse. And on March 20th, right near the bottom, his fear took over. He sold everything. So what happens next? Well, by the time Kevin felt emotionally safe enough to jump back in, it was August. And guess what? The market had pretty much completely recovered. He bought back in, sure, but he did it with $62,000 less than he'd had before. That's a permanent loss. Money that's just gone. You see, the index fund did exactly what it was supposed to do. It was Kevin's behavior that failed. And that's the big takeaway here, folks. Simple does not mean easy. And Kevin's story, it's not some one-off thing. It happens all the time. So today, we are going to break down the 4 big index fund mistakes that nobody ever warns you about, the behavioral traps that cause even smart investors to lose, and more importantly, how you can make sure they don't happen to you. All right, let's kick it off with mistake number 1, the big one, the absolute portfolio killer that Kevin fell for, the panic sell. This is so much more common than people want to admit, and it's basically the number 1 reason why most people don't actually get the returns the market gives. Okay, look at this chart. It really just lays the problem bare. Year after year, research from a firm called Dalbar shows the same thing. The average investor makes way less money than the actual index funds they're invested in. How is that even possible? Well, this difference has a name. It's called the behavior gap, and it's caused entirely by our own emotional baggage. So what is the behavior gap? It's literally just the difference between what the investment returns and what you, the investor, actually get. And it's caused by doing exactly the wrong thing at the wrong time. We buy high when everyone's excited, and we sell low when everyone's scared. It's the price we pay for letting our emotions drive the car. So how much are we talking here? Is this a big deal? You bet it is. A 2022 study from Morningstar found this gap costs investors around 1.7% every single year. That might not sound like much, but on a $500,000 portfolio over 20 years, you're looking at $400,000 just gone. Poof! Wealth that you should have had. Again, the fund worked perfectly. The human messed it up. Okay, so how in the world do you prevent this from happening to you? Well, the answer isn't reading more books. It's about pre-commitment. You have to build systems that protect you from yourself, from that future panicked version of you. That means writing down your investment plan when you're calm and rational. It means automating your investments so they happen no matter what. And it means being brutally honest with yourself. If a 30% drop in your portfolio is going to make you physically ill, then you probably shouldn't be 100% in stocks, no matter what some chart says. All right, let's roll into mistake number 2. This one is sneaky. It's a trap for people who think they've done everything right, who think they're diversified, but are actually making a massive concentrated bet without even realizing it. I call it the concentration trap. So you buy an S&P 500 fund, and you think, great, I own 500 companies, I'm diversified. But here's the thing. You don't own equal pieces of them. These funds are market cap weighted, which is a fancy way of saying the biggest companies take up the most space. And by late 2023, the top 10 companies, we're talking about the big tech giants, they made up a jaw-dropping 30% of the entire index. So your so-called diversified fund is really just a huge bet on a tiny handful of stocks. And if a little voice in your head is saying, that sounds kind of risky, you are absolutely right. Because this isn't a new phenomenon. We've seen this movie before, where a top-heavy index full of can't-lose companies doesn't end well.
Just look at Japan's Nikkei 225 index. Back at its peak in 1989, it was packed with companies that everyone thought were just unstoppable. Well, guess what? It took 35 years, 35, all the way until 2024, just for that index to get back to where it was in 1989. Imagine that, an entire investing lifetime spent just trying to break even. That's why real diversification means going global, not just putting all your eggs in one country's basket, no matter how strong it seems today.
Okay, mistake number 3. Now, this one's a lot more subtle. It's not a sudden crash. It's more like a slow leak, a silent portfolio killer that drains your returns over decades. It's the hidden fee drain. Look, not all index products are the same. A basic S&P 500 fund from someone like Vanguard might cost you a tiny 0.03%. But then you have these products sold as convenience solutions, right? Like target date funds or robo-advisors. And they often just layer their own fees right on top. That little innocent-looking extra fee, say 0.4% on a target date fund, over 30 years, that could cost you more than $165,000. Turns out convenience can be very, very expensive. And that brings us to our 4th and final mistake. And honestly, this one is kind of the foundation for all the others. It's this myth that index investing is just set it and forget it. I like to call it the discipline delusion. Now, to really get this, let me ask you a question. There's a famous story about the brokerage firm Fidelity. They did a study once to see which of their customer accounts performed the best over time. So, what do you think the best investors all had in common?
Well, the answer is kind of shocking and pretty funny. The absolute best performing accounts belonged to people who were dead, or the ones who had completely forgotten they even had an account. And why is that? It's because they couldn't do anything. They couldn't meddle, they couldn't panic sell during a crash or chase the hot new thing. They just left it alone.
And that just brings us to the most important points of all. Your biggest enemy in investing isn't the stock market. It's not high fees. It's not a bad economy. It's that person staring back at you in the mirror every single morning. It's our own fear, our own greed, and our own impatience. So let's wrap this all up into a simple toolkit you can actually use. Number 1, pre-commit. Write down your plan and stick to it. Number 2, truly diversify. That means going global, not just one country. Number 3, check every single fee. Seriously, 5 minutes of homework here could save you thousands and thousands of dollars. And number 4, automate everything. The more you can remove your emotional self from the day-to-day decisions, the better off you'll be.
Which brings us full circle, back to the fundamental truth about index investing. The whole industry sells it to you as easy. It's not. The strategy itself is incredibly simple, sure, but actually executing that strategy through terrifying market crashes, through crazy bubbles, through decades of your own self-doubt, that is one of the hardest psychological challenges you will ever face. So I'm going to leave you with this one last question. Just knowing that it's hard is the first step to actually winning. See, Kevin's mistake was thinking the hard part was picking the fund. He didn't realize the real hard part was managing his own emotions. So you have to ask yourself, what systems have I built? Is my portfolio actually protected from me?